what I'm going to talk about today is how machine learning help us manage risk. Obviously there are a lot of people wanted to use machine learning to make predictions in the financial market, and most of that effort have been unsuccessful for obvious reasons. Because machine learning requires a fairly significant signal to noise ratio to learn from the past. But the financial market is anything but. If there's a strong signal to noise ratio, a human would have spotted it already. There are, literally millions of traders in the world looking for these signals. So by the power of crowdsourcing, you would expect that somebody have discovered it and arbitrage it away. However, in applying machine learning to risk management, we found some success because the risks that we want to manage are private to ourselves. We are trying to learn from our own track record, unique to us. Nobody else trying to beat our track record because they can trade our hedge fund track record, right? They can only trade the public market that everybody can see. So in learning from our own track record, supplemented with big data, we are able to reduce the drawdown of our strategy and manage risk significantly. So that's an aspect of machine learning that we have found to be really practical, and it's not really the normal or the naive application that people think would be applicable. So, but in particular, this technique is called meta labeling by Dr. Lopez de Prado, namely that you have to start with your own strategy. It could be a discretionary strategy, it could be a quantitative strategy, it could be a fundamental strategy, it doesn't matter. But the key is that we are trying to apply machine learning to learn from your own strategy to see when it might work and when it might not work, and generate a probability of profit for it. So I have written and talked about it extensively in the past, but today I'm going to take it a step further to see to talk about another application of machine learning. And it is somewhat similar to what a lot of equity investors are familiar with. It is, many people are familiar with the concept of factor analysis, right? So you have a portfolio and you want to find out, I'm sorry, is there any problem in my audio?
No, it's fine.
Okay.
No, it's fine.
Okay, great. Good, thank you. So the idea is that many people are interested in what exact factors contribute to the risk of their portfolio. It is not, many traders are, justifiably suspicious of black box predictions. So even if I can tell you, okay, your strategy has a probability of 70% tomorrow that it will make money, you might not trust it. Because where do you get the 70%? Or conversely, if I say your strategy has a, let's say, 30% of being successful tomorrow, and you might still ask, am I supposed to trust you and not trade this strategy simply because you say that it's 30% probability of being successful, right? So this black box setup turn off a lot of traders for machine learning, and that's what we are trying to overcome. With seizure selection, we will actually rank the inputs, rank the factors, if you will, that go into the machine learning model, and tell you what it is that we base our prediction on, what it is that we rely on in a rank manner to say that your strategy only has 30% chance of success tomorrow, better not trade it, right? Oftentimes we eat our own dog food. If our machine learning systems tell us that we have less than 50% chance of profit, we will not trade that signal. And that has so far, every year that we have run it so far, has saved us over 10% in drawdown, right? It's quite significant. 10% drawdown is quite daunting to a lot of investors, and it has saved us that. And so that's the topic I'm talking about today, is how do we apply machine learning to figure out what are the most important factors, or in machine learning speak, features that affect the probability of success of our strategy or portfolio? And that topic is usually called feature selection in machine learning literature. Features are synonymous with predictors. For those of you who are statisticians, you might be more familiar with the term predictors or the X variables, or in the asset management industry, it's called factors. In college statistics, it's called independent variables, the X variables. They are all synonymous. And the key is that in machine learning, unlike in traditional macroeconomic or econometric analysis, or in even traditional quantitative finance, the more features, the merrier. Before we have the fear that, oh, it's going to overfit. We don't want to have too many X variables. A lot of them are collinear. We want to make sure that they're independent. We don't want to have those that are useless, redundant, or noisy variables. We have to be very careful in selecting what input you have in your model, right? That's the mindset of the traditional econometricians or the traditional quant finance researcher. But in machine learning, the mentality needs to be changed. The more, the merrier. Typically, hundreds, 200, thousands of factors are welcome, right? That's a big task supposed to create this data. That's why we need big data, right? But generally speaking, you can be indiscriminate. And the keyword is indiscriminate in adding features to your model. The more, the merrier, because of this technique called feature selection. The machine learning algorithm itself is going to prune down the set of features so that they are no longer redundant, and they will get rid of, filter out all those noisy features, and only the informative subset will remain. So there is no fear to start with the biggest set available, because eventually it will get down to a small and useful set. That's the process of feature selection. So what is the point? Why should we filter out those uninformative and features? The reason is that these uninformative features might create overfitting. It might generate a low bias, but it might increase variance. In machine learning speak, bias means in sample error. Variance means out of sample error. With a lot of features that you use, it might actually decrease in sample error simply because of overfitting, fitting to noise. But that will not do anything good for you in the out of sample. So because of that, so one major advantage of feature selection is that it will improve out of sample predictive accuracy, not in sample. Indeed, in sample, it might decrease the accuracy, but it is key that it will improve out of sample predictive accuracy. Is there any proof of that? We have written 2 papers, one published in the Journal of Financial Data Science, the one that Lopez de Prado was the chief editor-in-chief. We are publishing it. We have already published it in the winter issue of this year. And the second one is published in the Society of Technical Analysts journal about a even more advanced technique of feature selection that we applied. So the proof is in those 2 papers. If you're interested in the numerical proofs, just take a look at that. But beyond improving predictive accuracy, as I said, one of the key advantage of feature importance is that it allows you to interpret the model. It's no longer a black box. Black boxes are scary. Black boxes are, raise suspicions, but this is transparency. This is interpretability that we are providing with feature importance ranking, because we will tell you exactly what features are generated. Now, I'm not going to talk about the exact algorithm that we use for feature selection. It's called MDA. If you're interested, read our papers or read other books. We will talk about MDA. So let me keep this from being too technical. Okay. So one of the difficulties in feature selection, no matter which algorithm you use, is that the result often vary depending on all kinds of randomness. Now, I have a client to predictnow that uses our system, and he can complain that, hey, every time we train a model or we get somewhat different result. Well, that's inherent to machine learning because machine learning involves a lot of random permutations of data in order to improve the robustness of the prediction. So, but one side effect of this is that when you rank the feature using, let's say, run it once, and you run it again using a different random seed and to select the features, oftentimes the features that are ranked, they will have different importance rankings. So, for example, let's say we are trying to predict the USO, the oil ETF return, right? And using a bunch of technical indicators. This is purely toy example. Do not think too seriously about it. So let's say one time we'll find that, 2-day volatility is important for predicting the USO return. And 5-day return is important. So the top two factors are, 2-day volatility and 5-day return. And however, if you run it with another random seed, all of a sudden, the increase in trading volume becomes most important, and 2-day return becomes less, second one, and the 2-day volatility becomes the third rank. And then if you run it again, all of a sudden 20-day return become more important. That's actually real result, right? We actually apply this toy model with this toy set of technical indicators to try to predict USO, and that's what we found. So this is completely confusing because is it volatility? Is it return? Or is it really change of volume? That's most important to predict this USO return. We have no idea because of this randomness. So that's not very good. Another way to look at it is, supposing that we pick one feature. We want to run it, let's say 100 times with different random seeds, create 100 different machine learning models. Well, it turns out that maybe 34% of those will say that this feature has a top rank. And then 35% of those will say that this feature has a second rank. And then the rest of time has a broad distribution. Sometimes it's a third rank, sometimes it's a fourth rank, and so forth. Again, massive confusion. Is this feature really important? Because 35% of the times you say it's only secondary, but 34% of the time it says it's really the most important factor. This randomness is destroyed any kind of intuition or interpretability that you might gain from feature selection. And so many people have used feature selection blindly. Because why? They only use it with one random seed. A lot of people, when they publish research, they only look at one random seed and they get this feature selection algorithm, have this output, and they take that as the given truth. And that's not obviously really legitimate, right? Because if you actually try different random seed, you'll get different ranking. So you're fooling yourself to think that, by the way, volatility is most important. It's only most important with your particular random seed. If you change the random seed, it's not important anymore. So that is a very dangerous result, obviously. So what do we do to reduce this kind of variability, this randomness in the feature importance ranking? Well, we apply a technique called clustering. The main contributor to why there's this randomness in the importance ranking is due to what is called substitution effect. That is, many features that you created might be similar. They might be collinear, they might be highly correlated. And so, for example, if you have a feature that is measuring 2-day volatility versus a 5-day volatility feature, well, one time the 2-day volatility might be ranked top, and then another time the 5-day volatility might be ranked top. And they are very similar. So, even though they vary in the exact feature picked, you can sort of intuitively understand that, okay, volatility is important. No matter it's a 2-day or 5-day volatility is important. But unfortunately, I have like a bunch of features that are very similar in measuring volatility. Maybe 2-day, 3-day, 4-day, 5-day, 7-day, and they all get, shuffle around as you change the random seed. So it makes for confusion. So in the clustering technique, what we do is that we apply clustering to group these features that are similar together in cluster first, and then we apply the machine learning feature selection algorithm on this cluster as a whole. Rather than to individual features, we will apply them to all the feature in a cluster as a whole. So all the similar features will be forced to have the same importance ranking. So in our volatility example, 2-day, 3-day, 4-day, 5-day, 7-day volatility will all be in the same cluster. And therefore, you would not be confused because either the volatility cluster is important or it is not important, right? So there won't be any confusion. It's either important or not important. You won't find that the 2-day volatility is important, but the 7-day is not important. That will not happen. So that's the key to this so-called cluster-based feature selection that we have written the second paper on. And which again, if you wish a copy, please email us at info@predictnow.ai. I will send you a copy of the preprint. It's free, so no worries. It has not yet been published. It's been accepted for publication as the STA journal, but once it's published, you will have to buy it. But before publication, I have the preprint that I can send you as long as you email us at info@predictnow.ai. So the clustering technique that we use is called hierarchical clustering. Essentially, you start with groups of one feature, and then it will merge any two features that are close together, and then it will merge any two clusters that are close together until an optimal number of clusters. How do you define this optimal cluster is a technical subject, but essentially, we will group together clusters that are homogeneous and yet are far away from each other. So a good quality cluster is one where in turn, for all the features within the cluster, they are very similar. And for all the features that are in between clusters, they are very dissimilar. So there's a sort of a measure of how dissimilar and how similar they are. And if you reach that criteria, you stop the cluster. So the number of clusters that we reach is based on this algorithm. Now, in our system, that's what we implemented. However, we are also going to add a feature where you, the user, can control how many clusters, because you can actually see the cluster. If you use our, we're going to have a demo at the end. Our colleague Radu is going to demo it, but that demo uses this automatic cluster quality threshold. But in the future version, we will allow you to see the cluster themselves. You already can see the cluster, but in the future version, you'll be able to adjust the threshold so that you will get the ideal number of clusters that you find intuitively appealing. Okay, so sometimes a bit of a human intervention is good in machine learning. You don't want to be completely automated. So in any case, let me give you, but before I go on an example, let me take a look at if there's any questions. I don't want to keep blabbling on without answering any questions. Yeah. Yes, okay, so there's a question. What happens if we happen to use XGBoost for training or random forest algorithm? So our research are all based on boosted random forest. So in particular, on our website, we are on our predictnow.ai SaaS, we use light GBM as the back engine, right? So it's a boosted decision tree for both regression and classification. So it is a random forest and it is a boosted decision tree, but we use the light GBM package as the backbone for that. Let me see if there are any other questions before I babble on. So yes, we have many backtests. Again, if you download our two papers, if you go to our site, you can the JFDS paper cannot be downloaded because of copyright. They are very stringent. The Journal of Financial Data Science. Once you publish it, nobody can download. So you have to reach out to me privately, please. But the other paper you can still download, and indeed you will find comprehensive backtest results. And the result was as I suggested. It has a improved predictive accuracy if you apply feature selection to both benchmark data set and to a real live trader strategy data set, which is what we use for benchmarking, tail ripper strategy. But it's not just backtest, it's a live trading result. But if you want to compare with benchmark, because with live trading result, it's hard for you to validate, right? Because I'm not going to share our proprietary strategy with you so you can backtest it. But so therefore, we also perform this comparison on many public data sets that you can in fact audit. You can in fact compare your result with ours. So in particular, we have done the research on a non-finance data set called the breast cancer data set, and that can be very illuminating. This is the data coming from the Wisconsin Hospital Oncology Department. Basically, they extract 30 features from the images, the radiological images of breast tumors. And the objective is to identify which tumor is cancerous and which one is not, right? So that is the application, that's the problem. It's a public data set, it's widely used in machine learning for benchmarking purpose. And what we find is that if we apply this clustering algorithm and then the feature selection algorithm, it identifies highly intuitive clusters. The first cluster are the geometry of the image, of the tumor image. That's the most predictive of whether the tumor is cancerous. And the second most important cluster are the texture. And so you can see that if you are a radiologist, if you are an oncologist, and you look at this cluster, I'm hoping that you will have an aha moment. You will agree. You say, my goodness, you guys are right, because that's exactly what I look for too. Despite having 30 different metrics, I really only look at 7 or 8, and you guys have identified. That is what we expect an oncologist to say to us. We haven't talked to any real oncologists because we're focusing on finance, but that's what we found from our benchmark database. And furthermore, the predictive accuracy of applying feature selection on this data set is higher. If you don't apply feature selection, it is poor. And if you apply feature selection, it's over 90% accuracy in predicting whether a tumor is cancerous. But that's the easy part. Predicting medical data set is actually easy compared to finance, because the tumor is not going to evolve just because your machine learning algorithm detected it. Whereas in finance, if you detect something and trade on it, very soon it will disappear. So that's more challenging. So let's take a look at a finance data set. And that's the one that my colleague is going to actually use for demoing later on, is to predict the 1 month ahead SPX return, the S&P 500 return. To be precise, we have excess return, not the raw return. It's minus the risk rate, but that's minor matter. So the features are fundamental and technical features, things such as the dividend price ratio of the index, earning price ratio, and so forth, and the volatility. And again, this is a public data set, it's not private. Both the returns as well as the features that are used are public. So you can download it from this professor's website, hec.unil.ch. I listed it at the end. So with that data set, what do we find? We find 2 important clusters. The first cluster are all the fundamental variables. And that is comforting to those fundamental traders. Say, aha, I knew it. To predict 1 month ahead SPX return, I should get rid of, I don't care about the noise. I don't care about the 3-day return, or is it today's the average true range is large or small, or is there momentum in the 3-day? Forget about all that. It is the fundamentals that are important. That provides them with some comfort, right? If you're a fundamental trader, you see this result, you say, great, it really supported my hypothesis. Or they, to a technical trader, that might become a surprise. They say, I thought that I should use technical indicators, but no, this research clearly indicates that if you're predicting at a 1 month time frame, fundamentals are more important than technical. And that might provide new information. It contradicts to your intuition, but it might change your outlook of how you should trade this strategy. So it can be very informative. The second cluster, I call it technical, but actually in the latest version of the paper, we call it interest rate factor. If you look carefully, many of the variables that go into the second cluster are interest rate related, yields related. And so what is it saying is interesting is that 1 month ahead prediction actually fundamental economic growth is more important than whether the interest rate or inflation rate is going to go up or down. That's what it's telling us. So that can be insights that you can use as a discretionary trader, or as a quantitative trader. You can, as a discretionary trader, certainly you're going to pay more attention to economic variables than to interest rate. And as a quantitative trader, you might think of including more economic variables in your model to predict this 1 month return, instead of just sticking to your technical indicators or to volatility. You will look more carefully at fundamental economic variables instead to build your model. So it could be useful. These kind of insights can be useful to all kinds of traders, whether quantitative, discretionary, or fundamental. So again, before I go on further to the next example, which is our tail ripper strategy, let me see some questions. Okay. Would clustering the features reveal correlation? Yes, that is the idea. There will be, usually when you cluster things, the unimportant clusters, we rank the cluster, right? It's not just a matter of cluster, but we are going to rank the cluster. So typically, the less important clusters will be the ones that are containing noisy feature and redundant. Now, I think that your question is also about whether it will reveal correlation. And indeed, clustering, the whole point of clustering is to group together features that are highly correlated, but they don't remove them. It's like if you're 2-day, 3-day, 5-day volatility as your features, they won't pick, pick and choose. Oh, I only want 3-day. No, the idea is that we don't know whether 2, 3, or 5-day are, which one is particularly useful because they are so highly correlated. Instead, we are going to treat them equally. They are all going to be used in building the ultimate machine learning model, right? After feature selection, you will use a trimmed down set of features and to build a new model. And 2, 3, 5-day volatility will all be included in this new model. We do not choose among them because they are so similar. It's pointless to pick and choose among them. So there's a critique that this algorithm is selection data which aligns the algorithm to result its expected results. I'm not completely sure what you're driving at, Rana. The result could be expected. It could be surprise, right? So in the beginning, nobody know that the fundamental variables in this case are expected. You could have expected technical variables because you might think that 1 month is still very short and fundamental economics may not be important. Or you might think that interest rate would be most important at a 1 month time frame. So the fact that it ranked fundamental higher than interest rate factors, to me, is not necessarily an expected result. So I am not sure that I would call that a bias problem. The next question is, did you ever observe results of important features which had decreasing benefits? Well, whenever you're doing a feature selection algorithm, it is with respect to a specific time frame, with respect to a particular label, right? The label could be 1 day forward return or 1 month forward return. So definitely, if you select a feature like fundamental feature that are important for 1 month return, that feature may be completely unimportant if you're trying to predict 1 hour return. So that's for sure. Yeah, that is guaranteed that important features will not be the same. You can change it from 1 month to 1 week and it will all change. So machine learning has to be, all these algorithms are with respect to a specific set of what we call labels, the dependent variables. And in this case, the dependent variables are 1 month return. If you change the dependent variable or the label to 1 day return, you're going to get a completely different set of features. So that is for sure. Now, there's a question from Edison. He say, if I'm comfortable to use all features, does it make sense to still do feature selection? if all your features are already carefully crafted, such that they are none of them are redundant, they are all independent, and that they are also none of them are noisy, so they are all useful, then running the feature selection algorithm will not help, obviously, because you already handcrafted them to be the best set of features that human can select. So the machine likely won't beat it, right? But in real world, none of us can really ahead of time know that the features we created are like this, that they are uncorrelated and that they are not noisy. It's hard to do that ahead of time. So the reason that you feel comfortable that this is the best set of features is because you have done a manual feature selection over the years. You have added and subtracted feature and tested it many times. What feature selection algorithm do for you is to automate that process, right? So it will save you time if you explore a new problem from doing this manual curation of the features. Yes, so another question Rams asked, what are these cluster scores? The cluster scores are the feature importance score. If you don't use cluster, each feature will have different importance score. But if you use cluster, all the features within the cluster are assigned the same score, because all the features are forced to be included or not included in that cluster. So they are forced to have the same score. Yeah. So yeah, so that's the idea of cluster. So I don't know if I explained it adequately, but feel free to follow up if you have further doubts on that. Okay. I have 5 more minutes before we go to demo, so let's get on with it. Thank you for your question, by the way. I certainly thanks. Happy to answer them. So for the tail whipper strategy, that is what we applied. So this is really a live traded strategy. We have at some point we had about $60 million deployed on this strategy from different clients and different accounts. So the tail whipper strategy is a crisis alpha strategy. It only makes money during crisis. And we had now about 170 features. But because, sorry, backtrack one step. Because it's a crisis alpha strategy, and it will always suffer the so-called momentum crash. Like the last 6 months is a terrible momentum crash, right? The objective of applying machine learning is to find out when the market is not favorable to running a crisis alpha strategy. Is it when the market is calm? Is it when the market is going up? Is it when the market is has a high volatility but low kurtosis? What is it? Well, that's why we designed 170 factors. In the old days, it's 160, but we add factors all the time. So it's now 170 features to decide when is it not a good day to trade these tail whippers. Like today, for example, my colleague told me we should reduce size because today is not apparently a good day to trade crisis alpha. Let's see if it's right. We'll see. At 4 o'clock, we'll tell you. But anyway, every day we get a probability score from our machine learning to tell us if we should run this strategy, and if so, at what the leverage, right? So what we find if we apply this cluster-based feature selection technique to the to tail whipper is that, my goodness, it does confirm our intuition. The first 2 clusters have extremely intuitive interpretation. I won't tell you what they are because it's a proprietary strategy, but this really gives us confidence that we are doing something real, not just academic babble. Because the first 2 most important clusters, when we look at them as applied to tail whipper, are so intuitive and so sensible that you just got to believe that they are looking at something real, not noise, not random, stuff. So but that's only the first 2. There are 8 clusters that we find are important for predicting the profitability of our strategy, and we use them. We only use those. Therefore, in our machine learning model, we train the model using those 8 clusters instead of using all these noisy features that 170 features are the input, but when it comes down to it, maybe only half of them, I don't remember the exact number, only probably half of them or fewer will actually be included in the final machine learning model for risk management. And if you look at the result here, if we don't apply machine learning, the accuracy is pretty low. So without feature selection, this model doesn't work. Okay, it doesn't help us predict risk at all. If we apply the basic machine learning feature selection algorithm called MDA, it improves it to 53%. It already helps us to say something. But if we apply the cluster-based MDA, it gives us an accuracy that is a lot higher, from going from 53% to 61% accuracy in predicting whether that day is profitable or not. So that is a significant improvement. And like I said, applying this to our own strategies has saved us about 10% in our drawdown last year, which is very significant to the investor. But I'm going to introduce next our speaker, our colleague, Dr. Radu Silvano, who implemented the entire SaaS for us. This is his baby. So before I do that, again, if you want to try it yourself, please go ahead to register for a free trial at our website. In particular, just click on the try it free button. You won't miss it, okay? But Radu is going to try, to demo it to yourself. And the demo is also recorded, and you can view it on our landing page if you like. But I think it's more fun to see it done in real time. But before you do that, I see that I have 1 minute. Let me see if I can answer any further questions. No further questions. So I'll let Radu to take it away.
Good afternoon. Actually, good morning. Let me know if you can hear me. Can you hear me?
Yeah,
Yes,
we can hear you great.
Okay, good. Thank you very much.
All right, I need to unshare my screen first.
Yes.
Sorry, Radu. Yeah,
Yes,
I always
thank
forgot
you.
that.
No problem.
Yeah.
No problem.
Yeah.
All right, let me share my screen. Thank you. All right. So after you have registered on predictnow.ai, there in the registration box, you have a 1 month free trial, and you will start paying only $100 only after the first month. You need to register via Stripe. You will get this landing page, and you will see here that the website has two modes. One is the train mode and one is the live mode. Now in the train mode, you construct the machine learning model based on your historical data. And in live mode, you perform out of sample predictions. Now let me train a model by choosing the train mode. And here you need to upload a data set. And as Ernie mentioned in his talk, for the purpose of this demo, we are going to use the S&P 500 monthly returns data set, which is ranged from 1945 to November 2019, which means that, for instance, at this row, right, at the end of March 1945, you want to decide whether the April returns will be positive or negative. And in such a way, you classify the returns based on whether they are positive or negative. So a zero class in this returns column occurs whenever the future monthly return is negative or zero, whereas one class occurs whenever the future monthly return is strictly positive. Now, in the following columns include both fundamental and technical macroeconomical indicators, such as dividend price ratio, dividend yield, earnings price ratio, dividend payout ratio, stock variance, etc. For further information, you may consult the paper, A Comprehensive Look at the Empirical Performance of Equity Premium Prediction, And you can also download this data set from our website. So now I will upload this and click on next. Okay. So once you have uploaded this data set, here you need to fill in a form which deals with multiple options on how to train a machine learning model. First of all, you need to fill in what are you actually trying to predict, namely the target variable, also known as label. And in this case, I want to predict whether the future 1 month return is positive or negative. So basically the sign. And I will select returns. Now the data file is under time series format. So if the data file is under time series format, you need to make sure that your features are also stationary. And in order to ensure that your features are stationary, you further perform fractional differentiation, which is a technique popularized by Dr. Marcos Lopez de Prado. The target variable is under class format, so we leave the classification option. For the purpose of this demo, I will let cluster MDA as a feature selection algorithm. You can choose either SHAP or just use the whole feature set. For speed purposes, I will leave the level of machine learning hyperparameter optimization set to none, meaning that you actually default to some predefined parameters for constructing the light GBM model. The size of the test set I will deliberately put at I will deliberately put it to 6%, meaning that we capture the time frame between mid 2015 up to the end of 2019, and they will be used as a test set. The type of ensemble learning will be led to gradient boosted decision tree. We also have some options such as DART. Sample weight probability calibration will be left to their default values. And I will select the exploratory data analysis to yes, because you will get some simple statistics about your input data set. Namely, this would come handy when checking for outliers or errors in your input data. The suffix name is just a name for your machine learning model. So just to keep track of things, I would say just cluster demo 18th of March. Yeah. And now I have clicked on next. Okay. Once we are comfortable with the parameters that we have chosen, we click on run model. Okay, and in the meantime, please let me know if there are any questions. So you see here that for this demo, the execution has been very fast. One of the reasons for it is because you don't do any hyperparameter optimization, because that would also take some time. But in general, at the end of your training, you get a results link via email as well. So the idea is the larger the data set is, it could happen that the more time it takes. So for transparency, this data set has about 14 columns here and 900 rows. Okay. Now, after the results link has been obtained, we click on the results link. And you see here the performance metrics for both in-sample and out-of-sample data. So the in-sample from 1945 to mid-2015, whereas the test set is from the other half of 2015 up to the end of 2019, okay? So we have 3 performance metrics which are related to machine learning models. So if you are interested to construct like other metrics like Sharpe ratio and drawdowns, you might use these predictions that you obtain via the platform, and then you construct the backtest. Because one of the use cases, as Ernie suggested, is meta labeling. And meta labeling is something that it's a vetoing system on your existing trading strategy. So the model, as a use case, the model will tell you whether or not you should trade. Now, the accuracy, F1 and AUC score for the in sample are quite acceptable due to the fact that an AUC score greater than 0.5 is quite good in financial machine learning. Now, if you look at the test set, for this example, I will take the results with a grain of salt, because indeed the accuracy is superior, but one also needs to take the other performance metrics, such as the AUC score, which is slightly inferior to 0.5. And we also need to take into account that the period between the mid-2015 up to the end of 2019 had been a bull market. So somehow the classes, there are more one classes than zero classes. So when deciding whether a model is actually good for production, you might want to look at all performance metrics. And that makes sense because, first of all, it's a public data set. And second, if only using these 14 features, you could accurately predict the 1 month future returns, that would be extraordinary. So in practice, one would like to use it on the returns of an existing strategy rather than trying to predict returns. So this is just for demo purposes. As a buy and hold strategy, for example. And now we would like to look at the output. So in terms of output, we see here the statistics, the simple statistics in the describe output for EDA. We get for every column, we get mean, standard deviation, minimum, maximum, different information about the percentiles. And as stated previously, this is good for outliers or errors in our input data set. The cluster feature selection scores, it would be good to have in the future a nice interface regarding this. At the moment, we you do get a list of clusters with their corresponding importance score. So you see here as there are two clusters, cluster 0 and cluster 1, with their corresponding importance scores. And every cluster will have the respective column names, right? And right now, the way you decide, because this is the whole feature set for this example, the way you decide which features are actually selected. Well, first of all, you look at the importance scores of all clusters. You take an average of all importance scores. So as you see here, the cluster itself has an importance score, not the individual features. So basically, you select those features from the corresponding clusters whose importance score are greater than the average. This is the current threshold criteria that we take, but we might want to expand on that and introduce other rules. And as I stated, if you look at the feature selection list, right? The feature selection list contains features from from the first cluster. So the feature from the second cluster are discarded in this case. And you get the performance metrics file. In the performance metrics file is just the output that you get in this box. The reason for it is because at any point you might be interested to download your files. So for instance, you want to do some work offline, you want to compare different models, and you want to choose which one is best. And that might come in handy rather than, okay, I'm just going to go on the website, fetch that results page, and yeah, something like that. Okay, now let's go actually for the predictions. What actually this platform predicts. So I will go for the test set, the out of sample set first. And then since we seem to run out of time, I'll go to the live mode. So for the out of sample test, for the out of sample predictions, first of all, we get the labels. So we see here, we have time column, And we have another column called true target. True target is basically the truth, whether the future returns at that month had been positive or negative. And the predicted target are actually the ones that the model predicted. And for this example, you see here that the prediction are much in line to the truth. But again, it is important to first of all to look at all performance metrics when deciding whether I do want to trade this model into production. And in the probabilities in the probabilities file, actually, you will see the confidence that the model has in placing that that return into a 0 or 1 class, because i.e. positive or negative. So for this example, the model has a 66.6 confidence with that the model is in class 0, i.e. the future 1 month return would be negative, or vice versa, it has 35.3% that it's going to be positive. The reason for displaying all of these is because in general, we also allow multi-class problems. So for multi-class problems, you need to state all the probabilities for the respective classes. So meta labeling is using binary classification. This is one use case, but one may use it for different purposes, different problems, regression or multi-class classification. And one application for it would be that you might want to use it for risk management. So at a certain point you say, because at the moment the threshold is 0.5. So if it has greater than 50% confidence, with probability greater than 50%, it will label it as a 1, whereas otherwise it will be labeled as a 0. You might want to deviate from this threshold rule and say, okay, I'm not going to place the trade, right, unless the probability for 1 is greater than 70%, right? So you might want to tweak that and be more conservative in this retrospect. Now, also, you might want to use it on how you want to place your trades. So, for instance, okay, the model has a high outputs a high probability of my trade being profitable, about 80%. Okay, good. I'm going to increase my capital for it. Or the model tells that's only 57% probability to be profitable. Oh, okay. I'm not going to enter the trade, or I'm going to put only a very small capital. You might want to be interested to use it as this. And now let me show you the live mode. So first of all, you want to download the model file. Okay, and now I will click on the live mode. And in the live mode, you need to upload the live data set. And the live data set, the format of it is as in the following. You might have, it's like you're using it for production. This is simulating how you might want to use it for production. So for this, you have one row, but it's not really bound to one row, but usually in production, you have one row. And you have these returns, which is an empty field because you don't know in advance whether your trade is going to be profitable. And you have this column format as before with their respective values. Of course, these are updated to reflect the reality for this row. And let me upload it. Okay. Okay, and now I need to find the model. Let me. Okay, this one. Okay, so once you have done this, you click on predict, and you've got two outputs. One is the predicted targets, So if you want, you can look at whether what is the class what is the predicted class. So the model tells you, okay, at the end, so the future monthly returns, basically the January returns are going to be positive. And now, if you look at the predicted probabilities, predicted probabilities, you will see here that with a high, it has a high probability of being a positive return. Okay, and with it, I will finish the demo, and I thank you very much for your time.
Thank you very much.
Thank you.
Do we still have time for a few questions? Or are we out of time?
No, we have time. In fact, there's a good question Edison asked, whether an API is available. In fact, we just launched our API last month, been used by a few users for the premium subscribers. So, we have 2-tier subscription right now. One is a basic subscription, which we offer the no-code interface that Radu has used. And then there's a premium subscription level for people who want to use the API in addition to no-code. And we will also going to integrate data. So right now, the data are all provided by the user, right? If you want to create 1,000 features, some from the futures market, some from stock market, some from macroeconomic indicators, well, sorry, you have to create them yourself as an input to our system. We only provide the software currently. But next month, we are going to integrate stock fundamentals features coming from the financial statements of the companies. So the premium subscriber will have access to that as well. All the data will be free to premium subscribers. As to the price, is a negotiable. It depends on how much hand-holding we want, because for a premium subscriber, we also offer consulting service as part of the package. But if you don't want the consulting service and just want to use the API and the data and the software, it's a different price point. So let us know if you're interested in the premium subscription. First of all, try it out for free, right? Try it out for free. If you like it after 1 month, then you start paying $100 a month for the basic. And if you still like it, you want to go to premium, talk to me, and then we will figure out a good level of service for you.
Very good. And by the way, I took the trial, and I always recommend to people to take trials. I think it's a possibility for you to experiment a little bit with your own indicators and let it see how it clusters them, I guess, and see if there's any possibility of getting some feedback right away without going to a lot of trouble in developing the whole stack of systems that you would need to do it. So I always subscribe for free for the trial period, and then I cancel and then reevaluate whether or not I might have a use for it. What kind of people are using this, Dr. Chan?
We have users that are professional traders, as well as smaller hedge funds. On the higher end, we are actually talking to some American banks, asset management divisions. They are interested. We haven't onboarded them yet. But so currently, most of the users are professional traders and smaller hedge funds.
Sure. But if people want to try it out, even as just amateurs, they can do it, and that's what I may come back and do. Let me just invite other people here. Does anyone have some questions? Please just turn on your mic. It'll save time from typing, because we only have perhaps a few minutes left, and I'd like to bring in other people. Just going back, is there anyone here? Please turn on your mic. Somebody who wants to ask a question. Let me ask, meanwhile, the point of the classification, or that I hope everybody got, and correct me if I'm wrong, Dr. Chen, is that it separated the two categories, which are fundamental and technical, viewed only in retrospect. It's unsupervised. You didn't provide to the algorithm those names, fundamental and technical. It figured that out entirely on its own. Is that correct?
Yes, that's the clustering function. The classification is a different thing actually. Classification is whether we want to predict whether the strategy will be profitable or not, right? Profitable 1, not profitable 0. That's the ultimate prediction. But as a side benefit, we will rank the input also and group them into clusters. So that clustering into fundamental and technical variables is automatic. So we were surprised to that they are so interpretable, right? So the names I give it to them. You can see that the first cluster are all economic growth variables, and the second cluster are all interest rate variables. But that come from an automatic algorithm. There's no human input, but it does provide intuition to a human. So that's why I can put a name to it.
Okay, there are a couple of questions in the transcript. You're welcome to take a look. Rana is asking, what is your competition? There are numerous providers with similar value propositions. Are there though? I haven't seen them.
Well, there are many so-called machine learning package out there that are trying to tell you whether you should buy Tesla tomorrow or GameStop the next day, right? They have all kinds of signal that they tell you that they learn from sentiment, they learn from technical, they learn from economic. And they range from a company in Georgia called, it's spun out of Georgia Tech. I can't remember the name right now. It's not that I didn't want to tell the name. I truly forgot it. But some of you may know a company, AI company, come out from Georgia Tech. But from what I learned from this software, they are all trying to predict the public market. They're trying to predict something that everybody can see, which we view as which are unlikely to succeed because it's such a low signal to noise ratio. We, on the other hand, are trying to learn from your own trading. So I basically recommend that you have a somewhat stable, somewhat successful strategy before applying this, because our objective is risk management. Our objective is to improve the profitability of the strategy. We don't want to be the primary alpha generator because we view that as very foolhardy to think that a machine can beat a human trader in their intuition and insight into the market.
Yeah, and just putting in my own interpretation on that, Rana, I think it's very different. What Dr. Chan is not just offering, is not some black box AI system. It's really a standard stack of algorithms that you could put together yourself and can do so. But what he saves you is the labor of doing so. And moreover, he's doing his as a second level system. The first level, you develop your own algo completely. You already have it. It could be fundamental, it could be technical. And then you run this as a second level, as it were. It's called, Dr. Prado invented this approach called meta labeling. Dr. Chan, correct me if I'm wrong on that.
Yes, it was written in his book. I personally have read that book 5 times, and I can probably get maybe 60% of the insights of his book. So I recommend everyone to read it. But yes, meta labeling is the technique I'm talking about. We basically commercialize that technique in our platform. And Dr. Lopez de Prado have given a lot of talk. He's currently, he previously was the head of machine learning at AQR, this multi-trillion-dollar hedge fund by Cliff Asness. But now he's the head of machine learning at the Abu Dhabi Investment Authority. But he's a great researcher. He's the quant of the year, basically, well recognized. But the key insight is that he had been talking to all this in all this seminar, and he keep telling people that most machine learning hedge funds fail because they want to use machine learning to predict the prices. What you should use machine learning to do is to predict the success of your own strategy. That's what meta labeling is about. And we follow that philosophy, right? We approve of that because we have internal experience. We also try to use machine learning to predict price, and we fail. I have tried to do that since my days in Morgan Stanley in the early, late 1990s. My goodness, it's been long. It's been a long time, and we fail. It's not just I fail. Everybody I work with fail. And only in recent years we found success with machine learning, and that is in risk management, in capital allocation, in feature ranking, like what we discussed today. Finding what are the predictors that are useful. Those are the applications that are really useful. Not trying to predict, if GameStop is going up tomorrow.
Yeah, all these pseudo machine learning applications or very naive machine applications attempting to predict price are not going to succeed. Does anyone else have, this is a more sophisticated approach pioneered by Dr. Prado and Dr. Chan. Now, I'd like to bring in somebody else verbally. I think it adds to, well, let me read Steve. We can look at Steve's question. One being a buy signal, if it has a 55% probability with a 1 or a 0, could that be interpreted as a neutral market? I don't know how would you interpret that, Dr.?
Okay, yeah. So first of all, if you are thinking of meta labeling, 1 or 0 doesn't mean it's a buy signal. 1 means that you should go ahead with your strategy, trade your strategy as you like. 0 means your strategy is not going to make money today, so stop trading it, right? So you can't really short your strategy. It's not recommended you would go against this original trading signal. 0 just means that your strategy is unlikely to succeed. So don't trade it today. But if you insist on using this machine learning system to predict price, which you can, return to be precise, you can. I don't recommend it, but you can. Then yes, indeed, if your label is the sign of the return, then 1 means that return is positive, 0 means the return is not negative and not positive. And if it is the 55%, I wouldn't say that 55% means that we are predicting the market will be flat. As I said, in the market, in the financial market, signal to noise ratio is very low. A 55% probability of that the market is going up is actually a strong signal. If you read the books by some of these authors about Renaissance Technologies, about these managers at Randtech, which is never had a losing month in the last 25 years. Well, you will see that they say that a 51% edge would be what they are looking for. Every signal they got is like a 51% edge. If you get a 55% edge, you are going to be like better than Randtech. So you do not think that 55% means that you should, the market is flat. 55% almost like you should go all in long, because in machine learning, a 51% probability is already significant for financial market. Unlike in, for example, the breast cancer data set, as I mentioned earlier. In breast cancer, we get 95% accuracy. But that's not in finance. That's in medical applications.
Okay. Go ahead, please.
So related to the idea, this is John Goodwin here. Related to the idea that you were saying, where it's difficult to have that level of confidence prediction, what percentage would you say of that challenge comes from the market itself as a mix of different people and strategies, and what part of it would you say comes from the fact that there are concentrated sources of movers like large hedge, funds, retirement funds, portfolios, and when they move in and out, their decision may not be intuitive to you, but the fact that they did it moves the entire market.
Right. So let me, if I understand your question correctly, John, you're asking how do we take into account the fact that some of the market movement are due to liquidity provision and the withdrawal in the market, and not to fundamentals? Is that what you're asking?
Right. Like basically different major factors that don't happen on a similar time scale.
Okay, so our platform is of course agnostic to all these, right? So if you think that there is signal at different time frame that might affect your strategy profitability, let's say order flow. Let's say you think that the order flow to the fixed income market or the fixed income future or the fixed order flow to the S&P 500 futures are significant. Because order flow clearly is an indicator of market liquidity demand. And if you think that's important, incorporate them. And in fact, we are integrating order flow precisely in all futures to our platform. We should be available 2 to 3 months. So, essentially, you should include factors from all time frame and from all different markets, be as broad as possible. You do not need to be afraid. Just throw them in. You think that the 1 day order flow might be useful? Well, throw in 3 day too. Throw in 5 day order flow. Why limit to 1 day? Because feature selection is going to tell you whether 1 day order flow or 5 day or 3 day will be important. So you don't have to worry about throwing in noisy features.
And a separate and related question is, what sense do you have of whether or not the algorithms of this sort of trying to understand the market are basically chasing the interpretation of other people's algorithms and the net effect of what is going to happen when the market moves, like the activation of other people's buy and sell signals, or their rules, if you will?
Well, I mean, that is actually more of a question of feature engineering than machine learning, right? So certainly, we are trying to learn from other market participants, right? So for looking at our crisis alpha strategy, tail ripper, we want to guess if option activity is important. We want to guess if energy commodities are important. So we want to know what other people are looking at in trading that determine the probability of strategy. So a lot of people, for example, say that crisis alpha, doesn't work when people are buying too many call options, all these retail call option buying activities. So if you want to test that out, you can include a call option open interest, for example, as a feature, and then throw it in, and then run feature selection to see if it finds that it is important. What's the rank of a call option open interest, right? So you form hypothesis. It's very scientific, really. You form hypothesis on what might affect your strategy profitability. What are other people looking at? Is it sentiment? Is it option activity? Is it Fed interest rate changes? Whatever. Is it non-farm payroll changes? Unexpected non-farm payroll numbers. You can form all these hypotheses and throw them in, and then apply feature rankings, like what we just discussed, and then it will tell you what it is. It will reveal to you which one of your intuition is borne out by facts.
Very good. I see Steve is asking a follow-up question as to how would you handle looking for it? In other words, lots of us are neutral options strategy traders. We're selling a range or selling a butterfly, broken wing butterfly or whatever. How would you go looking for a non-trending market, or a market you don't care which way the market goes, you just hope it doesn't go anywhere?
Right. I think Steve asked the question, if my factors are looking for neutral strategy, right? And a one would mean it has a high probability of being neutral based on my factors. Neutral strategy, I think you meant a market neutral strategy. But if you apply machine learning to a if you already, so Steve, I want to understand, are you applying meta labeling, or are you trying to use machine learning to find the trading signal yourself. Because if it is meta labeling, we don't really care if it is a market neutral strategy or factor-based strategy. We only care whether the strategy will work tomorrow or to the next hour, right? So the fact that it's a high probability means that it's likely to work. And if the market is flat, means that your strategy work, all the power to it. But we don't really care about the market in that case. We only care about your strategy. If you are looking,
sort of go ahead.
Yeah, if you're saying that you are trying to use this to predict the market itself, that's a different matter. If you're trying to say that, oh, I want to predict the market movement so that I can decide whether to run my strategy. Let's say your strategy only works if the market is flat, then yes, you are trying to predict the market itself. You can do that with perhaps some success, not a high degree of certainty, certainly. As I said, it's very low signal to noise ratio. But yes, in that case, you can say that, well, I'm going to predict the market is going to go up with a high probability. So, and your strategy doesn't work in that environment, you can use that as a signal to stop your strategy. It's a kind of a little bit roundabout way to use machine learning, but it can be done. Yeah.
Right. So it's sort of a distinction that people need to try and figure out. It's a subtle one in a way, but it's absolutely essential. What you can use machine learning to predict, to find a neutral market or to trade it, but that's not what Dr. Chan is doing primarily, although he does that also and separately. But for this particular approach, you just run your own trading system, and you look at the results, profitable or loss. And what he's now trying to deal with in the machine learning is shading that or second guessing or evaluating the decisions made by the original trading strategy only. In other words, he's trying to predict whether that strategy will succeed or not on a given day. Anyway, it's a very good point. Who else has a question that they can open that they can say on the mic? Is there anyone else? Let me just see. Anyone else have a verbal question? Please just turn on your mic and ask it if so. Otherwise, go ahead.
Hi, I have a question, Dr. Chan. Very nice presentation. My question is about hyperparameter tuning. Do you think that if I switch a different set of features or different instruments in a different market, do I need to really go through the hyperparameter tuning again and again, or can I use a default one even if I add a new feature? What's your experience in general? Could you share anything about that?
I would often apply a light amount of hyperparameter optimization whenever you change your data, right? Because by increasing the number of features, it might require, for example, a few more trees in your random forest ensemble to reduce overfitting. It might require going down a more maximum depth for your decision tree. So yes, changing your data oftentimes requires slightly different set of hyperparameter, and I would recommend you do some light one. Light in the sense that don't necessarily have to run it 100, 200 iterations to get to the absolute local minima or maxima, but at least try to get halfway there, so that the starting parameters are not completely crazy. So that's what we have by default, is that we have a small amount of hyperparameter optimization that we do by default in the system.
Okay, very good. I see there's another type question from Ram. What are sample metrics that define the signal to noise ratio in the financial instrument arena?
Well, I would say that essentially you can just look at the training set performance metrics that Radu showed earlier. Also, evidently, accuracy is one. If you have a strong signal to noise a song signal to noise ratio, you will see accuracy over 60, 70%, right? But typically we'll get 50 to 60% accuracy in finance. Another commonly used metric is the F1 score. And then the third one that we display is called the AUC score. AUC score is, is usually accepted as the most representative metric of whether a machine learning system has predictive power. It takes into account multiple sort of parameters of the system, not just a point estimate, but it really look at the whole curve of different estimates. So it's a more robust estimate of whether a machine learning system has any predictive power at all, not by chance that you pick the right hyperparameter, but as a whole. So
yeah, and this is actually go ahead.
Yeah, and that is usually in finance is again between 50 to 60%. If you can get an AUC score over 60%, you're doing something amazing.
I think Dr. Chan has to go. Is that right?
Yes, I think we should. If there's no, certainly feel free to ask me questions by email. You have my email. info@predictnow.ai. That's the best email to use. Easy to remember. And I'm happy to answer any question. And again, if you join the trial subscription, free trial subscription, you will have access to a Slack channel. And a lot of people ask questions there, and sometimes my colleague answers, sometimes I answer. So the discussion can definitely carry forward over these forums.
Do they need to do the trial to get access to the Slack?
Yes, they do have to sign up for a trial to get access to the Slack.
Okay. Well, thank you we're going to continue offline, a few of us here, anyone who wants to stay around. But let's end the formal procedure and let Dr. Process and let Dr. Chan and his associates go. Thank you very much. It's just tremendous to get your perspective from somebody who's actually successfully using machine learning today in his hedge fund, and also is contributing to very accessible tools for everybody.
Thank you so much for your invitation, Don, and thanks everybody for their time in listening to me.